Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Miles Harris. Miles has a BSc and Masters in Economics. He's been studying financial crises since 1999, and history doesn't repeat, it rebrands. Miles, welcome to the show. How are you?
Oh, good. Yeah, it's great to be here.
Really looking forward to this. We were just speaking off air. We've got a lot to talk about today. Digital IDs and the state of the world, and financial crises and so forth. But just if you can, a little bit more about yourself in general, if you can.
Yeah, okay. So obviously, as you know, with my bio there, I got into economics at university. Well, I opted to do it as my main degree course. Particularly enjoyed the real world elements of economics, and rather than the abstract theoretical and mathematical principles, which just didn't really resonate with the real world to my mind. So I got into really focusing on transitional economies, given that this was sort of late 90s. And then there were a series of financial crises that broke out, starting with well, I suppose you could say Mexico in 1994, but that they really did begin to accelerate thereafter and went down like dominoes in Asia in 1997. And that was a key focus, and the contagion then spread to Russia, and then I wrote my final year dissertation about the Russian financial crisis. Then went on to study a master's in economics, and wrote a thesis all about the Asian financial crisis, and comparing the comparative experiences of Asia versus China. And this touched on a number of key themes, which included like IMF orthodoxy, international capital flows, and the way in which countries were opening their borders to international capital in what's known as capital account liberalization. So those were really key themes. And then I sort of gravitated towards the city, and was very interested in working in finance and banking at the time. And I had a lot of friends who were based in working in the centre of London, and it just ended up not really resonating. And prior to that, I'd also got into property investment, and bought my first house while I was still at university. And I actually did that with a mortgage which was self-certificated. I had a little bit of money from a relative passing, and that sort of almost started an investment journey for me, which I then soon realized, because of the rapid appreciation in property prices that was taking place, that I didn't actually necessarily need to be in London to actually make, relatively good money. I wasn't really thinking about the ethics of my decisions, and I must say that I've matured a long way in terms of yeah, the monetary ethics that I now apply to my life, I would say. So, yes, and then thereafter, I thought, right, well, more people really need to understand good economics. I was really into the Austrian School of Economics, and
Mhm.
taught that at 17, 18-year-old level. But I was fortunate to be teaching in a very, very capable, high achieving school, and have some very capable students who were deliberately put on a course which was teaching at a level, at university level, and incorporated key research projects such as China and the global economy. And we ended up sending kids all over the world to some of the best universities in the world, including Harvard, LSE, Oxford, and all those big names really. So yeah, I enjoyed that, but it really, there wasn't the freedom and autonomy to really kind of pursue um, teaching beyond the specification, and that really
Mhm.
started to frustrate me as the rules within qualifications became tighter and tighter. And so, yeah, now, I'm just focusing on my writing. I'm in a very fortunate position. I've had a break over the last few years, and I'm just, really enjoying life, and grateful to be here.
Oh, no, so loads of things to touch on there. First of all, property background is something I rarely talk about, but it seems we've both got a property background. I should also give a shout out to our mutual friend Ian Burlingame for putting us in touch in the first place. And leading on from that, obviously you've mentioned a lot of different financial crises there, Mexico, the tiger economies, and Asia in general. So this might be a bit of a full-on question for question number one, Miles, but what are we seeing in the financial and global economy and the plumbing today? And are there any similarities to any of those crises that you mentioned from about 30 years ago?
Yes, well, just going back to the comparative experiences really of China and Asia there in terms of their economic development. The Asian tigers were, of course, developing very rapidly, and they had decided to open their borders to foreign capital as well as applying this credit creation, which was ultimately driving a speculative boom, but it was also leading towards a lot of dollar-denominated debt. And therein lies, a crucial weapon of essentially financial colonialism. And that is by forcing other countries to actually utilize your currency.
Mhm.
You have control and power over them because if their currency then struggles, well, they've got to pay back, 20%, 30%, 40% more in dollar terms. And they've also got to be able to get a hold of those dollars. So that's an interesting dynamic. And that, of course, builds into what we're seeing now with things like the Genius Act. And the role of the dollar, which is now being effectively outsourced to private companies to be able to provide dollar liquidity worldwide, which of course has previously just been the sole responsibility of um, yeah the traditional banking model and then central bank
Mm.
swap lines and so on. So this is a brand new innovation, but what that also means, and rather than institutionals grabbing hold of dollar liquidity, you've now got the facility for individuals across the world to create a new wallet and get their hands on dollar access via these stable coins. So that's obviously a key development. And then just going back to why China wasn't subjecting to any sort of financial crisis, a big reason for that was that they had not actually liberalized their capital account. And that ensured that they weren't as dependent upon dollar flows, and they had also managed, of course, their credit creation much better than had been conducted in the Asian economies. So, yeah, I think that's a very interesting dynamic because what we are now seeing now is the presence of what appears to be a regional block via Mbridge of multi-currency CBDCs, really, to allow regional trade to actually take place. But China has very much maintained its gradual approach to its economic development.
Plenty to unpack there as well. And I know that you just mentioned, credit creation, money creation as well. And I'm not sure if you've listened to Richard Werner's podcast with Tucker Carlson. I listened to that over the weekend, and that was absolutely mind-boggling because he was going
Mm,
back and talking about the Japanese, and I think it was Deng Xiaoping visiting Japan, and he went in depth, really in depth about it. And
mm,
again, the main well, I took a lot of things away from that, but again, it's that ability to create credit is I think almost it's almost like the hidden secret of everything in the financial plumbing. That's what I took away from it. I'm not sure if is that a sentiment you would agree with, or is there anything else to add to that at all, Miles?
Yes, absolutely. Without question, Richard Werner's work has had the most profound influence upon me, and my overall understanding of economics, really. It literally turns the whole world of standard economics and IMF orthodoxy, as I mentioned earlier, and the so-called Washington consensus. It turns all of that upside down, really. And when you then consider what Deng Xiaoping undertook in 1978, and still even today, the decentralized nature of the Chinese banking system. Now, I say it's decentralized, but at the same time, four of, I think, the five largest banks in the world are actually Chinese banks. But that said, the state has control over their credit creation and where they should actually lend and how. And then they break it down to regional areas and then local areas and so on. And so that model has proved enormously effective for China. Yes, I just wish that I had been exposed to Richard Werner's work earlier, to be honest, because it is not mainstream within universities, and it really needs to be.
Yeah, I'll try and find a link to the podcast for anyone that hasn't listened to it yet. It's about 2.5 hours, but it's the other thing that I took away from that was when he was talking about uh, almost fraud within the system, and he was using the example of the mercantilists back in the day, where you were talking about gold merchants, and they started to figure things out. And he gave the example that someone could walk up to gold merchant, and they need 300 ounces of gold, whatever it was, and then the goldsmith, I should say, uh, gave this person the gold, then got the person to deposit the gold back with them straight away, and then gave them
Mm,
a receipt. And again, I think he explains that yes, you've got double entry bookkeeping there, but he said, in effect, did the person walk into the goldsmith with the gold? No. Have they walked out with the gold? No. But there's another 300 ounces now on the balance sheet, so to speak. He said that's fraud. And he put it so simply, and that sort of sat up at night, and I was, oh, my eyes have opened. So I'll
mm.
find a link to the podcast. But what I should stop rambling, so I get told off for rambling. So all of that being said, what what other myths or things that what do you think people should need to know about a lot more and have their eyes open to a lot more? What do you think people are sleepwalking into at the moment?
I think firstly, there's this growing understanding that actually whether they're a political party on the left or on the right, um, they're essentially moving the country, that given country, towards the same direction. I think that's becoming much better understood. But like personally, I certainly think that is true of a national level as well, and that we are moving towards a system where effectively you've got many flags, but you've got one true command. And so
Mm.
while it looks as though on the surface the facade is that the world and the global economy and so on is fragmenting, under the surface, when you actually look at the pipework of the new monetary system that is being built, and first started to be built around the early 2000s with the ISO 20022 capabilities, you then start to realize, well, there is this uniformity under the surface. And to my mind, that's really quite profound because it's still widely thought that the BRICS are a separate group which are entirely independent. Now, the evolving monetary system gives them capabilities to ensure that their governance is slightly different, and of course that China, Russia, and so on can maintain their state-controlled banking system. But that also works to the West's advantage because it means that the Western commercial banks will focus on, say, US Treasuries as a key holding on their balance sheets. And that will be a key means by which the government continues to fund itself, whether that's in the UK, the EU, or the US. So that I would say is something that there needs to be more awareness of, that actually there is just this system of multipolarity which almost appears to be designed where you don't necessarily have a dominant force, and de-dollarization has been carefully orchestrated, I would argue, and we can of course come on to that.
Well, absolutely. Let's dive into that. You mentioned ISO 2020, I think it was. So again, for people that are not familiar with what that is, what is ISO 2020?
Yeah, so essentially, ISO is like a messaging glue for money, really. It's first developed, of course, under the International Standards Organization, and it allows electronic data interchange between financial institutions, and it doesn't matter whether they're public or whether they're private sector. And anything that is actually being built in the mainstream, whether it's stablecoins, whether it's central bank digital currencies, is essentially being built onto that platform.
Mhm.
Now, there is real need for a better, faster, more efficient process for international payments because I'm sure yourself, like living in Mexico, if you're ever sending money, it's fragmented. It means that you do have a number of intermediaries, or you do have high costs to actually undertake in exchanging any funds. But the key capabilities really of ISO 20022, the metadata element, and that ensures that the identity of the originator and the recipient is known, that it's all KYC'd, but it also enables other data such as invoice numbers and so on to be attached to that money flows, and that's also then said to be compliant with AML or anti-money laundering. Then you've got the automotive element of it as well, that it categorizes all of the transactions that are actually running through the system, and so that formats it in XML categorization, so you know exactly why those transactions are taking place, what they're being used for, and so on. But most fundamentally and most importantly for the everyday person, you've got that cross-border interoperability so that it works across borders, and that doesn't matter whether you're in China, Russia, or whether you're in the US. So that's really quite profound. And what this pipeline essentially enables is the programmable element to really flourish within central bank digital currencies. So ISO 20022 itself is a neutral innovation. It depends, therefore, how it is actually being used, and of course, there's many concerns regarding the programmable element within central bank digital currencies and stablecoins there.
Well, that leads me perfectly onto that point itself, is that I think that most people that would listen to this would agree that, do we need a more efficient financial system and, more efficient ways to, do cross-border, currency payments and things like that. I'm sure most people would listen to this and go, yeah, absolutely, we need that. And at the same time, again, not just because my contrarian whiskers start playing, but is that case of, well, how much control do you then start giving across with, data, information, and so forth? And I think a part of that is a fine balance. But again, yeah, most people would agree we need it. But at the same time, do we want to give up that element of control, especially in CBDCs? I'm just making an assumption there about what people might be thinking. But again, let's dive a bit more into stablecoins and CBDCs, because they've been, or they will play very likely a major role in the financial plumbing moving forward.
Yes, they certainly will. I think the intention is really quite profound with stable coins, and something that I've considered in depth on my channel has been the profitability that they really do offer for these private institutions that can then generate significant yield on the issue of stablecoins. And what you are effectively doing is taking public debt and you are turning it into a direct private revenue stream. And so, of course, the taxpayers are going to have to pay for that. So it means that when money is received by one of these private stablecoin providers, they will then back that one to one with treasuries. So they've spent that money, but then they mint the stablecoin. They're left holding the treasury. Treasury is what's supposedly a high quality liquid asset. So they then hold the treasury, and then they collect the yield on that treasury. So yeah, that could be 4.5%, 5%. Of course, these are T-bills themselves, so they're short term, and that's important because that's really about sort of reducing the amount of duration risk that they face. And that is potentially very, very profitable. So if you do have a look at the accounts of USDC, you can see that it's a very profitable operation. And I did see a graph the other day, which was essentially saying that the profit per employee generated by Tether is absolutely vast. Now, I only glanced at it quickly and I haven't really gone into it in detail, but it was a vast figure. And it dwarfed Nvidia. Nvidia's
Wow.
performance against that was just so small. It was just a tiny fraction of it. So that I think is fascinating. Now, of course, those regulated stablecoin providers, of which Tether is not one, will face higher costs. But I think the key point there is that they're largely initial startup and fixed costs. And so once you actually have a growing model, then it means that it becomes highly lucrative. And so, yes, it's not right in my eyes, and it does introduce new vulnerabilities as well, I believe.
To me, that all sounds inflationary, that you are creating or you are adding significantly, by the sounds of it, to that money supply because you're creating this demand for, in this case, US Treasuries via stablecoins. So to me, that sounds very inflationary. But it's very interesting also what you say about that going from public to private. And then pretty much at the end of the day, the taxpayers are likely to be on the hook for that. I find that absolutely fascinating and information that I think people need to know
Mm.
about, hence these conversations.
Yes, absolutely. Yeah, it is such an enormously profound change in monetary dynamics. It's absolutely huge. And what it also does is raise a brand new, what is known as Triffin Dilemma. And the Triffin Dilemma was coined after this economist back in the 1960s who was essentially saying that the US dollar had a responsibility to not just its domestic economy, so the central bank had a responsibility to the domestic economy, but also to the international economy to ensure that there are always enough dollars overseas. And so the primary means of getting those dollars overseas is, of course, to run a current account or trade deficit. And that exports the dollars overseas. But of course, that whole mechanism then leads to deindustrialization of the American heartland. Now, with stablecoins, it's slightly different because now what is happening is that the government is therefore encouraged to issue more as the market grows, which I'm sure it will because the profit incentive is there to ensure that it does. It really then ensures that, yeah, there's a demand overseas for dollars. And so in countries that are facing high inflation, they're going to much rather to hold stablecoin dollars than other currencies, and that that could actually lead to treasury bill yields to actually come down. And it's interesting what's happening, the juggling that's taking place now on the US debt, because they are starting to sell more T-bills, which
Mhm.
are, of course, the short-term denominated debt rather than the 10, 20, 30-year debt. So I imagine that as that debt matures on the longer end, then at the shorter end, they're going to be issuing more and more. And if there is significant demand, it does potentially have the ability to push down yields there to reduce borrowing costs. But that also provides a real incentive for governments to spend more. And if demand overseas for stablecoin dollars grows because other countries are facing a hard time with inflation and so on, and the depreciation of their currency against dollars, then that could also encourage the US dollar, the US to run higher deficits to fuel that demand overseas. And so no longer is the overseas supply dependent upon the trade deficits to the same extent. What they're doing is reining in the or trying to rein in the trade deficit seemingly, but potentially at the expense of the fiscal deficit. That's kind of quite complicated. It's helpful just to see it in a cyclical diagram, which I do go through. So yeah, that may be of interest to some.
I think you've made an excellent point there, Miles, because a lot of people, yeah, we could talk about the US debt all day long, to be honest. I think it's a fascinating subject. But if we look at Trump investment and the current administration, those yields on the 10-year treasury are too high. They need them to be lower, like you said, to refinance. If you're refinancing, is it 8 or 9 trillion, I think, either this year or next year or both? That's a lot of debt to refinance. And if you can bring that yield down from 4.2, 4.3, wherever it is at the moment, and you can bring it down to, let's just say 3%, that's a massive difference to the amount that you're going to be saving in interest. So actually, everything you've just said really does fit like a glove, so to speak, because it's now starting, to me anyway, make a lot more sense. And it sounds also to me that they they actually might know what they're doing, and it's very clever, I have to say.
Uh, yes, there's no doubt they know what they're doing, whether they make a mistake or whether they get something seemingly right. They know what they're doing, all right. And yeah, clearly, as we mentioned with Richard Werner, there are these untold secrets that are kept hidden to a degree. Even if you go on to study at a decent level, you're not exposed to them. So yes.
Just fascinating. My eyes are lighting up. I've got a little light bulb above my head as well because that explanation I think is brilliant. So in effect, we've got, just so I've got this clear in my head, that we've got basically from the public to private via stablecoins. They are then going to facilitate an increased demand, which would then put pressure on various yields, ideally to make them lower. And once they make them lower, then they're going to be able to refinance about 25% of the current 37 trillion that they've got. They're going to be able to refinance that at a lower rate, which would then again just help the economy, I guess, in the short to medium term. They're also looking to bring manufacturing back. And then I do hear and read that there's also they want to almost create $2, so like an onshore dollar and an offshore dollar. And again, your explanation really does fit into that we could end up with that system via, the stablecoin mechanism. That's what I take from that. Does that sound about right, or is there any corrections that need to be made there?
Yes, I don't know about the onshore offshore element, but I'm certainly very interested to see what implications the stablecoin development has when it comes to euro dollar markets. And as I was really just alluding to, that there is potentially an enormous risk here that will
Hmm.
build over time, just like Triffin said of his dilemma, which by the way is worth noting that that dilemma is actually really a tool of financial colonialism itself. So the ability to force other countries to actually depend upon your currency and have to make payments in your currency. Well, the experts in utilizing that strategy were Rome, and that's a very interesting parallel. So the Triffin dilemma in itself was certainly nothing new as of 1960. Yes, the implications of this are very interesting, but I also think that there are certain very powerful forces who do want to realign their assets away from the US dollar, and the stablecoin development potentially enables them to do that over a gradual period. Now, I do see and hear a lot of talk about crisis and crashes and so on, but I think it's clear that the trend that they're taking is not really about a dollar shock where there's suddenly a complete collapse in demand for US treasuries or something like that. You know, the approach that is actually being utilized is a gradualist approach. And if you have vast amounts of values in dollar-based assets, well, you don't want that system to crash. So you would actually look to offload those assets gradually over time, because in doing so, that doesn't put downward pressure on the asset prices, and it means that you can get out at a high value level, and then you can diversify into other assets. And of course, we're seeing lots of central bank gold buying as well as commercial banks in the East.
Yes, there is a lot of interest in the precious metal space at the moment, and again, especially with gold. I think a couple of weeks ago, overtook the euro as the second largest
Mm.
reserve asset
Hmm.
in the world. So,
Yeah.
as do what the central banks do, not what they say, is how I'd summarize that, to be honest. What, from your studies and your videos and everything else that you do, what else do you see happening that might not be obvious to the general public at the moment in terms of financial plumbing and what's going through in the background?
Well, of course, there is this growing trend towards tokenization, and I think that's a fascinating area because that is set to accelerate greatly as well. And I think people really need to be aware of that. And what that essentially means is converting real world assets into tokens, digital tokens on a blockchain. And there you've got a situation where tokens represent claims for the assets themselves. But in many instances, if you think about, say, gold, or if it's a stock holding, something like that, then those assets themselves are, of course, held by the custodians and platforms themselves. Now, you can say, right, well, that doesn't sound like too much of a change to things, but when it comes to tokenizing homes, that's a very interesting area to explore, because imagine you've got a $500,000, £500,000 home, and that's split into those 500,000 tokens. This raises all sorts of potential issues because if you've only got, say, a 40% share of that home and you actually live in that home, then you don't necessarily have the legal right of disposal of that home. And what that means is that you may say, right, I'm going to sell, my 40% of the tokens here. But what could actually happen is that all of the other token holders say, no, you're not. We want you to live there because you've kept it in a really good shape. And yeah, then you're almost forced into a position where you have no choice because you don't have that legal right of disposal. And that sounds absolutely mad. And I'm fascinated to see how they're going to kind of bridge these difficulties within an instrument such as housing, where of course you want to have that utility access, and it's not like gold or a share certificate, which is then held by an institution. So, real control itself equals the legal enforcement and the access. And with homes under the current system, where you do have the legal enforcement of courts, and of course, you've got the title deeds yourself, and that's all held on a land registry, which is legally enforced. But when it comes to any token, you are then subject to the terms on the contract on the smart contract there. So it means that programmable code then becomes more powerful than the courts, really. So how they're going to bridge all of this is very interesting, but this is going to be inevitable unless people are really aware of it. Because they are opting for a quiet, gradual approach. It's interesting we're mentioning this term gradual a lot with regards to
Mhm.
China, with regards to de-dollarization, with regards to, the way that this is actually all being introduced. And it is going to be inevitable unless people really become aware of it and actually start shouting about it.
What I take away from that is that, yeah, apart from the word graduate, like you said, we have mentioned that a lot. Is that it seems to be in line with things that have happened before. What I mean by that is, again, it's inch by inch by inch by inch, and then after X amount of inches, the whole world's changed, and people look back and go, "What happened there?" Again, because they weren't necessarily paying attention. I mean, the idea of tokenizing real estate or property is just, to me, is completely mind-boggling. But
Mm.
yeah, as you said, very interesting how they're going to deal with that. And do you think going on to CBDCs then, and we're talking about taking inches and doing things gradually, do you think that's the ultimate play moving forward in terms of a control mechanism from states over the people?
Well, it certainly could be. It certainly could be. I've got a couple of thoughts there, because with the stablecoin system, obviously, I've gone through the potential weaknesses in the longer term that generates, and that's something that people need to be aware of, I think. But really, central bank digital currencies themselves, they're just algorithmic compliance systems with a spending function. And Yes, I know they've been referred to as central bank accounts as well. And that is certainly one possible option. I think the only way they will get away with introducing those at a retail level where they will be accepted is through a huge crisis, as the one that I alluded to earlier. So that could be a potential gateway towards CBDCs as almost then what becomes a desirable savior, I suppose. But I think there's also a, a demand, not a demand, that's the wrong word, a desire among certain forces to introduce a global hegemonic synthetic currency, which is something that Mark Carney, I think, first mentioned in about 2018, 2019. Now we're a long way from that, but I see that as their ultimate sort of goal, really.
Yeah, when he was elected governor or prime minister of Canada, whatever the position is, I did say to someone that I know is Canadian, I just said, "Rest in peace." It's not good. I do agree with you. All joking aside, that I think that there's going to be some form of crisis manufactured, and then again, as we've seen before, I think in various points in history, not obviously not necessarily with stable coins or CBDCs, but I do think that something's going to be manufactured, and then they'll go to the people and say, look, all okay, we've got this financial crisis. Oh, sorry, that's happened, because of X, Y, and Z. Here's a CBDC. This will save you, and then people will lap it up, and then next thing you know, most people will be under the thumb. And it might sound good, but yeah, if that were to happen, that wouldn't be very good for many people out there.
Yeah, indeed.
want to, if we can, try and touch upon, because we mentioned at the start, it'd be good to go back a bit in history and try and learn some lessons from history. I know you actually brought up the Romans there with systems that they had in terms of finances. Do you think there are, or what do you think are the most important lessons that we could learn from events in the past with regards to maybe the changing of a financial system or how things operate? What parallels do you see? What do you think we can learn from instances in the past, Miles?
Well, I think there's numerous points to truly understand, and I think the more you understand about our monetary history, the more you understand why money is not actively integrated within history. And the sheer amount of reading that's necessary to actually gather together bits of information and key clues, and then really dive in and investigate those aspects is absolutely enormous. So I think there's numerous things that want to that are intended to stay hidden, and I just find it fascinating to dive into those. And I'm hoping that I can almost sort of stimulate a demand there, because it's not something which is natural. You don't go onto YouTube and search up like particular terms that I'm covering in my economics history videos, because ultimately you're not really meant to know about it. But what's interesting there is that there is an overall trend of course, the people having a hard time of it, but some people winning on the margins or in the margins. And that I find as a real kind of cause for optimism and a cause for hope, because some of the details that I'm uncovering and going into and discussing are quite sort of disturbing, I suppose, really. But there are numerous instances, despite people going through much worse times than we are facing, of them actually coming out pretty well. And so there's key lessons that can be learned there. And really, that boils down to an understanding of what true wealth is, because I think it's very interesting that we've been absorbed by this concept of money, which I perceive as an abstraction of what is true value, and true value is actually your family, your community. It is your ability to actually provide to some degree for yourself. And so within that, of course, you can help shield yourself with certain hard assets. And land is, of course, one of those. And that has typically been a key means by which peasants have managed to flourish despite odds against them, really, despite having high odds against them. And after all, these people are our ancestors, and they've really been through very tough times. So hard assets is one, community, skills, and tools as well, or know-how, having that knowledge. So yeah, I think those are key elements to focus upon there, really.
Yeah, I think anyone that thinks in 2025 that we've got it bad should go back and look at some of the things that have happened throughout the course of history, and you realize that actually, where the fact that have got the ability to be what 5, 6,000 miles away from each other on some technology and be able
Mm.
to record this, I think it is obviously much different from how things were back in the day. I always had this understanding that it's gold, silver, land, as you say, and also art are the three things that apparently over generations and generations are normally the things that will serve quite well. But all of that being said,
I find art a
history
very
is repeating
interesting
itself.
example, actually, and
Okay.
that's something that I considered in the latest video I looked at with regard to economic history, and almost. how the Renaissance was, in many ways, a deliberate creation of a brand new asset class
Mhm.
to help absorb all of the monetary flows that were taking place from Latin America. And so, receiving all of that gold and silver, they wanted to put it to use and essentially develop a brand new asset class. And that also, of course, helped in terms of reinforcing certain narratives like that you should just accept inequality, that certain people were destined to rule over others because they're almost sort of predetermined or determined by God and so on. So yes, there's a number of interesting elements there, I think.
Well, let's go into that because if you make that link, Renaissance, Latin American gold and silver, the first things that I think of would be the Medici, the florins from Florence, and the ducats from Venice would be the first things that I think of. If you don't know what a florin or ducat is, very famous gold coins. So yeah, Miles, go into that. I'm fascinated by that. Let's put these things together if you can.
Yes, well, it's certainly just fascinating to consider that at that time, what was also known is that in the East, under the system of Kublai Khan, Marco Polo had written in detail about Kublai Khan's monetary system, and it was a paper-based monetary system. And he had also effectively discussed what are tantamount to open market operations, where excess currency was being taken out of circulation or added to circulation, depending on the availability that was actually within the Chinese economy at the time. And so that was well known and well understood, but yet there was this apparent desire to go and search for more gold and silver, and that's really what it was about. It was also about capturing land as well, in my opinion. But what that meant was almost like a colonial expansion, and then eventually forcing the locals to have to pay tithes in gold and silver, and the barbarism that took place there was absolutely horrific. And some of the stories you do come across, you're just like, I just don't want to read this. Like,
Mm.
but all that entire flood of money then needed to be absorbed and utilized. And one of the key ways of doing that, of course, was to almost cause a rebirth of most notably the Italian cities of Florence, Venice, Genoa, and so on, but also further afield as well, as to whether that was Lisbon or Antwerp or Seville, and the Renaissance architecture that we're all familiar with, the Renaissance art, and much of that wealth is of course owned by some very powerful forces, and it's now become what's regarded as priceless. And of course, there's much beauty to it, but it was also at a time where capitalism was emerging, and
Mhm.
what's that also helped to actually do was reinforce higher aspirations and encourage people to strive more and work more. And as I said previously, to accept that sort of notion of inequality as being something which naturally occurred. And yeah, that's it's certainly a fascinating passage of history there.
Well, there's some direct comparisons there, I think, because you've just mentioned about paying tithes or taxes, as we might know today. Then also land grabs and taking something from here and taking it over there. It was just it just took obviously this took place in a different era with different, for obviously the tithing in gold and silver, whereas today it'd be, your fiat currency and, you pay your government or whatever it might be. But actually, there's a lot of comparisons there. So when we go back and say, well, this happened before, this is how it happened, we can look at today and go, well, this is similar to what's happening. The mechanics are the same, even though the elements involved might be different.
Oh, they certainly are. Yes, the first video that I considered in the series was really looking at a banking crisis, which was perhaps the largest banking crisis that has ever taken place in history, but is very much little known. And that was in the mid 1340s, and it was utterly devastating to Europe at that time, and it ultimately was another kind of key contributor into the enormous depopulation that actually occurred throughout that period. Something I've looked at in a subsequent video. So yes, there's that element, but you've also got the fact that these banks, which were supposedly collapsing, were meanwhile using methods which were being developed in Florence to diversify their asset base away from their normal operations. And so King Edward III of England was said to have defaulted, but at the same time, there were enormous conditionalities applied to the lending. So that included a share of revenue from wool exports, and that's quite an interesting dynamic. And I think he ended up, or the English crown at the time, actually ended up making their last payment to the Bardi and Peruzzis around about the 1390s or so. And that's sort of 50 years later. So the payments were still taking place. But what these banking firms had done is diversify into things like grain,
Hmm.
gold, silver, of course, holding gold florins. And when famine later struck because of the breakdown of credit systems, um, and the way in which the agricultural system depended upon such credit, it meant that the price of grain, of course, had spiked enormously, and vast profits were made. And then, of course, there was subsequent land capture and so on of that took place after the Black Death.
Do you, do you think, and again, we're talking about major crises happening, and I've got no proof of what I'm just about to say. I'm just sort of thinking out loud. You mentioned their 1340s, Black Death start, well, what we now know as a Black Death, the Great Plague started in what, 1346 off the top of my head. Do you think that's just a major coincidence, or do you think that somehow that could have been manufactured as part of this, part of a massive land grab? I don't know if you've got
Uh,
any thoughts on that at all.
I find the timing quite interesting. Certainly, I wouldn't want to be a provider of credit um, in the midst of 40, 50% of the population um, disappearing.
Hmm.
So I find that aspect quite interesting. You know, there's the prospect being much higher value added, even if you've got perhaps the security of making a loan on land, or and you can seize the land. You may well have the opportunity to get that land at a much lower price later. So the fact that there's these banking crises, and then suddenly there is this plague to hit is striking in terms of the timing that has actually taken place there. And then there's the sort of medical procedures of the day, which of course really did not help. And I
No.
think there's a book by Nancy Razi who has written about what took place there, and was one of my key references in writing about that in the essay on my channel there.
I'm gonna have to dive into that a bit more. Only as you were saying it, I was just thinking of the time frames. Yeah, something might not stack up there. But again, let's go back to the what we're looking at. So we've got a potential, even if it did happen naturally. We're talking about the Great Plague. Even if that did happen naturally, what we're seeing is that, as you mentioned before, it could be a land grab there. So you could the ability to go in, buy assets on the cheap and hoover that all up. Well, if we bring that back to 2025, it possibly we're setting ourselves up for something very similar in terms of can we depress the prices of certain assets? And then if you have the cash to hand or you have the mechanisms to hand, what you then could do is potentially, should asset values fall significantly, you could then go in, especially with land, hoover that up, and then, as they say, the rich get richer and so forth. I think if I'm going to make any comparison from 700 years ago, that's something that where we could look at and go, well, it happened back then, but in this format, and what's happening today, it could happen, but it could happen in a much more stealthy way. And again, this is the joy of doing these, podcasts and videos, is to have these conversations, get some ideas out there, and hopefully people can go away and either take action or at least, they start thinking about these things.
Yes, that's certainly the case. And really, I suppose I'm just trying to highlight issues and things that have taken place in the past without overly trying to lead people's thinking, but just really to promote awareness of what has happened in the past and things to possibly kind of consider in the future. So. Yeah, I certainly find that as to be one of the most fascinating areas of my work that I do now. And in addition to that, I think it also gives me a real edge in terms of what I need to look for when it comes to the latest executive orders that have come out and things like
Mhm.
this, because yeah, as will come out in time on my videos, there's some very interesting and very sort of devious caveats that are carefully added to acts which are in the economics community very well respected, and yeah, I find that all very intriguing and draw enormous parallels to say what has just happened when it comes to the Genius Act recently.
Well, let's finish up with the Genius Act if we can, Miles. We could probably talk for hours and hours being history people as well, but let's not subject listeners to that right now. We'll come back for a different episode, I think, and go into that. But yeah, let's finish up with the Genius Act. So I know that there's some yeah, coincidences with, again, things that we've already spoken about today, stable coins and money supply and so forth. But you've just alluded to it there. What have you seen in the Genius Act that, again, might not be in the mainstream media that you think people really need to pay attention to?
Well, I think what we've actually discussed so far is one of the key elements, and that is the fact, and I'm not seeing many other people really sort of pick up on that, is the profound implication that that has in terms of generating private revenue from a public debt like that.
Mm,
And that is a shift change. And I know you could say, right, okay, well. The Federal Reserve owns plenty of treasuries, and they capture the yield on those treasuries. But I think it's a 6% dividend that they provide to their shareholder banks. But the excess thereafter, after costs, of course, is then returned to the treasury. Now, when it comes to the Stablecoin Act, then it means that actually all of that revenue is being captured by the private sector, and it is being captured in a way that these systems can be programmed and built so that they scale to become more and more profitable over time. And those banks that are providing that stablecoin infrastructure include those global systemically important banks such as JP Morgan, Wells Fargo, and so on. So I think that really is the key dynamic. I think most people understand that there is a real parallel between central bank digital currencies and stablecoins now. I think that's being understood, so that the anti-CBDC element is kind of almost null and void, really. But that could provide one advantage that I haven't really discussed on my channel yet, and that is we were talking about credit creation earlier, and that is that stablecoins via alternative financial mechanisms could provide more credit creation for productive enterprise in the US. So that would be one potential advantage that I could cite as to a comparison against the Eurozone and the inception of the forthcoming digital euro in the autumn.
I think on that note, that's probably a fantastic place to leave that conversation. I think there's a lot of food for thought, I think, for people to take away. Miles, I know you've mentioned your YouTube channel a lot, and I'd highly recommend people go across and have a look. But I always like to give the opportunity for people to say, how can you be found? So again, anything you say, I'll provide the links in the post and obviously on the YouTube channel with this. I'll put all the links in the description. But people want to find out more and connect with yourself. How do people do that?
Yeah, so the best way is really my YouTube channel there, but at the same time, I still don't have enormous faith in YouTube. So I do make sure that I am available on other platforms. So I'm on X as it now is, and trying to be a bit more active on there. So that's Miles Harris LGA at that's my handle, and then Substack as well. So I'm also trying to embed my videos with the essays that I write onto the Substack page there.
Fantastic. And on YouTube, it's Miles Harris 5315. And I'll put a link to that again in the description in the show notes as well. I highly recommend people go and check out your channel and subscribe purely because there's a lot of fantastic information on there, especially to again dive into history and so many fascinating subjects and topics. Miles, next time, I look forward to, yeah, it'd be great to have you back for part two. I think we could, definitely dive a lot more into more historical aspects that we might not have covered today. But it's been a really eye-opening conversation, and I just want to say a massive thank you for your time today.
Oh, it's been a pleasure. Thanks so much for having me on.